Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today I want to talk about some of the movements that we've been seeing specifically since the beginning of August as we've entered into somewhat of a corrective process. This is not unexpected. If you joined us back in July, you will remember that I was saying that markets were absolutely setting themselves up, that they were going to have to take some sort of a breather as we came into the end of summer, early fall. Markets got very extended, very overheated. There wasn't really a whole lot more room to run. We talked about how if you stretch a rubber band, only so far can you stretch it. And so we've begun to kind of see some sort of corrective processes. The S&P 500 since the beginning of August is just off 2.4% of its high. So again, nothing really crazy, nothing that's invoked a lot of panic, just kind of trying to cool those markets off. And so if I show you from this chart here, these were the things that we were talking about. We were very extended from our moving averages. And so remember, moving averages are averages. And so eventually these numbers have to retrace closer in line. This is our 50-day moving average and our 200-day moving average. And so we can run extended for a period of time, but eventually there has to be some sort of a reconciliation, and either these lines have to move up or valuations need to kind of come down. So we were running very extended. RSI was also running extremely hot. And so anytime we get above 70% on the RSI, that's a sign of a market that's kind of overvalued, that's gotten heating up very quickly, and so it's not typically sustainable. So anytime we get above that line there, we usually expect to see some sort of a pullback. As a reminder, anything above 70, very overvalued. Anything under 30 is what we would consider to be a washout. So that would be a time where things were extremely undervalued, kind of like, the opposite. And so something that was brought up in our investment committee that really showed us that we were really set up for some sort of a pullback at the very least was these two areas of divergence. So I just want to kind of show you this because I think it was interesting. So what we have seen, what history has told us, that anytime we get a divergence between valuations and RSI, meaning that valuations are going higher and reaching higher highs, so kind of going in a positive, while at the same time RSI is going on a downward trend. So even though RSI was very elevated, we weren't hitting new highs on RSI, because you can see that slope there was somewhat down. Anytime we see that, that is always a sign that typically markets are going to have some sort of a pullback imminently. That played out perfectly so far for the beginning of the month. Again, we're only down about 2.4% off of the highs. And so as we were set up for this process with having extended, being extended from our averages, high RSI, seeing this divergence, we really just needed a catalyst for what was going to cause markets to kind of finally try to cool off. And for the month of August, it was the debt downgrade that was what ultimately finally spooked investors. And so I just wanted to share this, but I think it's important to discuss the fact that I don't think there's any reason for there to be any panic. We certainly have not seen panic selling in the market. And so here, when we look at this technical chart, you can see we came all the way down to the 50-day moving average. We basically kissed the 50-day moving average, and then we sat there, bounced off of it. So that actually acted as a very solid line of support. Now today, this is Monday, and so markets have opened up a little stronger today, so they're positive. So it'll be interesting to see how the rest of this week kind of plays out. If this 50-day did actually wind up acting as a line of support, that really will set markets up for potentially to go on to make new highs after that. And so right now RSI is sitting at 46. That's a much more comfortable RSI. We were very extended. We hit over 70 here multiple times. Now we're kind of sitting at 46. That's a nice comfortable measure for markets. And so there's a lot of reasons to continue to be bullish here, certainly at least in the intermediate term. And so I don't think there's a whole lot of concern in terms of what markets are going to do. Certainly we actually see some more positive things in the market. So one of the things that this chart here that I just wanted to show you is looking at S&P 500. That's going to be the blue line, versus the black line is the number of stocks that are on a bullish buy signal. meaning how many stocks are actually looking to be strong. Is it only a handful of stocks, or are we seeing that a broad range of the market is actually on a buy signal? And so that number has been increasing all year. So that is a sign of health within the index. So also something else that I just wanted to kind of show here is the fact that this green and red line, that's volatility index, so the VIX. And so volatility has actually gone down over this past month. So we've seen some corrections, or not corrections, a 10% pullback. So we're really just seeing pullbacks. We're seeing temporary cooling offs of the indexes, but the volatility has actually stayed the same or even lessened. So that shows us that people are not panicking. We're not seeing panic selling like what went on in 2022 and 2020 certainly. And so again, these are signs that I think that investors were not completely taken off guard by the fact that we started to see this these negative numbers come in. And again, we were just kind of waiting for that catalyst, and we've actually been kind of holding on. We have some cash on the sidelines, and we were waiting to deploy because of all these things that we talked about. We knew that markets were overstretched, overvalued. They'd gotten too hot too fast. And so the question is, have we kind of satisfied that need for now? And our market's about to kind of go off into to new strengths, or is there more to kind of come? And that we're not sure of yet. So certainly in the intermediate term, when we look out at a longer range, markets still look like they should be bullish, that we should be invested in stocks. One thing though that I think is interesting, we've talked before about those 5 big names in the S&P 500 that have really kind of helped to carry the index. And if you had been invested in something other than the top 5 names, that you likely would have had negligible returns. So that plays out very nicely in this chart when you look at the fact that in the S&P 500, only 28% of stocks in the index have actually outperformed the actual performance of the index. And so that shows us that even though they may be on a bullish buy signal, we are still being carried by a small minority of stocks in the S&P 500. And so that is, again, that we talk about breadth of the market. That is how are things going across the board, not just Amazon, not just Google, not just Meta. We want to know how are things going across the board. And so only 30% of stocks in the S&P have been able to outperform their indexes year to date. So that is something to keep an eye on. But again, when we look at long-term technical charts, really no reason to be pessimistic at this point. I think that the movements we've seen in August so far are actually setting us up to have a healthy potential fall, at least coming into the end of the fall. End of summer and early fall tend to be weaker times for the market anyways. And then a lot of times we see a lot of volatility in September and October until we get into November and December, getting into the Santa Claus rally as portfolio managers begin to window dress coming into the new year. So one thing I haven't talked about a little bit would be kind of where the asset classes are when we look at relative strengths against each other. One movement that was interesting that happened between last video and this video is that domestic equities leapfrogged over international. And so domestic equities is back in the #1 position, and then followed right below by international equities, and we're looking at buy signals there. So that was a move that we saw that was interesting. Mid caps and large caps are still those areas of strength when we look at the allocations, looking at sectors, technology, industrials, materials, and then consumer cyclicals are areas of strength. Healthcare has been an interesting area, so that's more of a defensive area that's just kind of been hanging out there in the middle. We haven't seen a ton of movement there, but wouldn't be surprised to see healthcare begin to have a breakout. So these are just, when we look at kind of trying to set the odds in our favor in terms of the technicals, and looking at what areas are stronger when they have to kind of go up against each other. That's what we're trying to do. We want to find those areas that are consistently winning, and we kind of want to steer away from the areas that are consistently losing. And that is how, over time, that's how tactical modeling works. And so those are the things I'm going to get into. So for the rest of the month, it'll be interesting to see if that 2.4%, if that was enough to bring markets kind of back down to a healthier place, or if there's going to be a little more pressure to go. So we'll have to wait and see what that goes. So again, this is where it becomes important to just make sure that you have that those rules that you follow in your investment portfolios. You want to make sure that you understand why you own what you own, and if they're no longer following your rules or fulfilling the job that was intended, that you're willing to sell them. So we always say that you want to let your winners run and cut your losers quick. If you have questions about that, you can always reach out to us. So my email is ashleyr@victoryfiduciary.com. You can also reach out to us on our website. We're always happy to answer questions and to talk. So we thank you so much for joining us today, and we will look forward to seeing you in September and being able to kind of discuss how things played out. So thank you so much and have a great day.